from the heart of where innovation, money, and power collide. In Silicon Valley and beyond, this is Bloomberg Technology with Emily Chang.
I'm Emily Chang in San Francisco, and this is Bloomberg Technology. Coming up in the next hour, Disney Plus users topping estimates, parks deliver, shares soar. We're going to break down Disney's results in a conversation with CEO Bob Chapek. Plus, more earnings. Uber in the green in late trading as fourth quarter revenue and bookings beat estimates. How the company recorded the most active users in its history. We'll chat with Lyft President John Zimmer as well about how the company reported fewer rides than analysts expected last quarter, but also its highest ever revenue per rider. All that in a moment, but first, stocks rallying, investors buying the meta dip after shares of the Facebook parent company slid post-earnings. Also watching Disney and Uber, of course. Our Kriti Gupta here with the details. Kriti, take it away.
Yeah, Emily, let's just start macro here. Green on the screen when it comes to the S&P 500. The NASDAQ rallying back 2%. If you actually look at the move for today, bringing that into perspective with the sell-off that we saw at the start of the year, well, the information technology for the sector for the S&P 500, well, it's pared back half of its losses in that pretty brutal sell-off, a 15% drop for the tech sector there. And you can really see what it's doing to that volatility picture. The VXN, that's that volatility gauge for the NASDAQ, actually coming back down a little bit, coming back down to a 26 handle. But Emily, on a macro perspective, all eyes are going to be to tomorrow's inflation report. And that's really where we have our eye on the 10-year yield hovering at around 194. Does tomorrow's report get it to a 2% level? And does that make any impact on tech? That's what we'll be watching on the macro perspective. Let's go micro, though, with those after hours earnings. Uber in particular soaring, those bookings beating those estimates. They came out with 118 million active users on their platform. Emily, that is their largest amount on record for the company, and they actually made quite a bit of revenue off. And you can see Uber's shares actually up in the pre-market. Lyft, take my word for it, is also up in the pre-market following Uber's lead. And a similar story when it comes to Disney, also beating their earnings with some pretty fantastic subscriber numbers. The estimate going into those Disney numbers were 125 million subscribers. They came out with 129 million total, adding 11.8 million new subscribers. But Emily, a lot of the growth, it didn't happen here in the United States. It happened over in India, their fastest growing market. 35% of the global subscribers for Disney now coming from their partnership with Hotstar.
Yep, big subscriber numbers there. Kriti, thank you. I want to stick with Disney results, bring in Tuna Amobi of CFRA. Tuna, what's your headline takeaway here, given the slowdown in subscribers we saw this quarter, but a big beat today?
Yes, indeed, Emily. Those numbers were way through the charts, both top and bottom line. But of course, as you mentioned, the headline is the Disney subscriber numbers, which way past our estimates. I think this really kind of answers some of the concerns out there as to whether the deceleration that we've seen some of the other platforms, Netflix and others, whether there was anything structural going on. I think what's even more remarkable, Emily, is that Disney actually had expected the acceleration to occur in the fiscal second half. So the idea that we're seeing this now when a lot of the content that they are planning to launch is still out in the front, I think that really speaks to the potential demand and appetite out there for streaming. And the other number that's gotten lost in the mix is ESPN Plus also adding north of 4 million subscribers. That was quite pleasing because some of the strongest numbers we've seen. So the direct-to-consumer business is really firing on all cylinders and should accelerate even more as we enter the second half of Disney's fiscal year.
Tuna, CEO Bob Chapek reiterating their forecast for 230 to 260 million Disney Plus subscribers by 2024. I wonder, though, is this going to be lumpy quarter to quarter, depending on content, given what we saw last quarter? And is it really got to focus on the long term?
Well, Chapek has made the point that it's not going to be a linear trajectory to hit that number. And frankly, Emily, as we kind of think about that number after what we saw this quarter, it's actually looking really, really conservative. So now they're at 130 million roughly for Disney Plus. And if you see how how fast they've gotten to this number, and the idea that they're still going to launch 50 international markets this year, taking them to over 100, and then next year they're going to be reaching 160 total countries. So I think it's really going to speak to how much traction they're going to get in a lot of international markets. So if I were to kind of go by what we saw, I think that number 230 to 260 is quite easily achievable at this point. But I don't expect them to raise that guidance, anytime soon until kind of certainly toward the end of this fiscal year, perhaps.
And what's your read on parks? Traffic lower or in line, but revenue up. Are fewer people just going to pay more to go?
There's a tremendous amount of pent-up demand for the parks, and we knew that going into this quarter, which is pretty consistent with what we've heard from other major theme park operators out there. What we didn't expect, frankly, was the velocity of the acceleration that we've seen. So all of the key metrics that we look at in the parks, seem to be actually, outperforming expectations. The operating income number beat our estimates by a lot. So attendance, guest spending is all-time high at the theme parks, and not just in the U.S. but around the world. So there's a tremendous amount of pricing power, in the parks. So this could actually be the silver lining coming out of this pandemic, where we see the parks, accelerating toward that peak attendance levels that we saw a few years ago, and the margin expansion is really coming back to life. That we actually expect the parks to hit peak operating margins faster than expected. Of course, subject to any uncertainties related to the Omicron variant.
All right, Tuna Amobi, CFRA. We're going to continue to listen to the Disney earnings call and share more headlines as we have them, continuing our coverage of Disney. Also later this hour, I'll bring you a live conversation with CEO Bob Chapek. You don't want to miss. Let's get more on earnings now from Uber, beating estimates on fourth quarter revenue, the most active users in its history. Tom White of D.A. Davidson has a buy on Uber, joins us now for his take. Tom, what do you make of the fact that Uber and Lyft earnings were so different?
Well, look, I don't know that they were massively different. With Uber, we got a pretty constructive update from the CEO in mid-December. They indicated that the EBITDA for the fourth quarter was likely going to come in towards the high end of the range that they had given. And then, Omicron hit. And so I think investors were wondering, was the kind of the drop off that likely could have happened in the business going to be so detrimental that it could kind of derail the quarter? And most people generally suspected not. And that's basically what we saw. We saw, a pretty solid quarter. The headline metrics, for revenue were above consensus. Mobility, the ride sharing business was a little bit light on revenue. But they beat on EBITDA, which I think in this market, the tape we're in right now, everyone's focused on profitability. No one's willing to pay for, unprofitable growth companies. And then, all eyes were on the guidance, particularly after what Lyft talked about last night. And, guidance did come in a little bit light. Gross bookings and EBITDA were a little bit below what investors were expecting. But the market was clearly kind of expecting that after what Lyft said last night. And Uber made the very important comment in the press release that, exiting January, they had already started to see a recovery in the mobility business, which I think is all investors really needed to hear to feel kind of comfortable with the numbers.
And yet they're both still continuing to suffer from a driver shortage. How big of a concern does that continue to be?
Yeah, well, look, I think it's improving driver supply, less of a shortage over the last month when demand has kind of shrunk a little bit due to Omicron. But, look, I think they're working their way towards finding balance in the marketplace. We think they'll eventually reach that. They've been able to, kind of peel back some of the incentives to attract drivers. You mentioned in the run-up, the MAPC stat, that's the monthly active platform customers, all-time high, 118 million in the quarter. It's really impressive to think that was their highest level ever, even though this is a business that in some ways has been shrinking, in areas, exiting certain countries, exiting unprofitable markets. with an audience that large across ride sharing and delivery, we think it's just a matter of time before drivers are attracted to the platform.
All right, we're listening in on the Uber call as well, and we'll bring you highlights as we have them. Tom White of D.A. Davidson, thanks for giving us your take. All right, coming up, Lyft hitting an Omicron speed bump. In their fourth quarter results, we're going to speak to Lyft's John Zimmer about his outlook for the road ahead. This is Bloomberg. Lyft reported fewer riders than analysts expected in the fourth quarter as Omicron put a damper on travel. But the riders that did take a Lyft generated record revenue per user due to higher fares and longer trips from the airport, for example. I want to bring in John Zimmer, Lyft president and co-founder. So look, John, record revenue per user, that's great, but riders not as high as expected. What is your outlook for the road ahead, given that Omicron is, it seems, waning, but we could still be seeing new waves of the virus?
Yeah, so for the full year, this year, we expect even faster growth than what we saw last year. So we're quite excited about that. Excited to see the health conditions improving so that certain states are removing the mask mandate when they feel like it's safe to do so. Hard to predict in the near term how quickly the recovery will happen, which is why we said we're cautiously optimistic for that broad recovery, but unknown exactly how that's going to impact the rest of Q1 and even touch on Q2.
Now, Uber just beat on almost everything, and there's a thought that they could have the upper hand given their scale in rides and eats. Are you at all concerned about alienating users if prices stay elevated?
Well, I'm not familiar. I haven't been able to follow what they're reporting on today. But one thing to think about in Q4 when you're talking about pricing is that there were a lot more, the ride mix changes. So you're not necessarily looking at a like-for-like ride from Lyft in Q4 or Lyft in Q3, meaning also our bike rides are counted with the overall ride. So when it's winter and less people take bike rides, there's less of those less expensive rides. And when more people go to the airport in Q4 to travel for the holidays, there's longer distance, more expensive rides. We didn't see any major changes to base pricing. And in fact, we're seeing service levels improve dramatically. So from Q2 to Q4, ETAs improved by 30%, and that brings down the dynamic or elevated part of pricing.
So when it comes to driver supply, we're still seeing concerns there for all the gig economy companies. What's your strategy to compete with those other companies, given that some drivers don't want to get in a car with another person? They'd prefer to just deliver a meal, and that's a business that you're not in.
Yeah, I mean, new driver activations are up 50% year over year. It's returning at a really fast pace. The concerns or questions that existed, call it in the first half of last year, compared to where we ended, we're in a much better position, extremely confident. If you compare our return of labor to that of the hospitality or retail industry, we're far outpacing that return to work. And if you just zoom out and think about what other option is there where you can turn on and off work and earn $20 to $30 an hour, there's no other option. And historically, rideshare drivers earn more money than delivery drivers.
What kind of risk does it pose to profitability, though, if this shortage continues, let's say quarter after quarter, and you have to deal with this labor issue repeatedly?
Yeah, but I mean, we're actually not seeing it repeatedly. So it is getting better. Service levels improved by 30% because supply has been less of an issue. So we could talk about, a hypothetical if that was true, but it's no longer the case that that's as much of a concern. So we feel great about our position, about the balance improving again, which ETA is a great measure of balance. And we're also getting ready for this a bigger return of demand of riders. We're going to continue to incrementally invest on the driver side, something that we've done historically I'd say, well, and in COVID had to do it with much more difficult conditions.
All right. Now, on that note, Uber CEO Dara Khosrowshahi, when he was last on the show at the end of last quarter, made this prediction about riders. Take a listen.
I am quite confident that next year we will be hitting records, all-time records in terms of mobility bookings. I'll make that prediction now.
Would you be willing to make that same prediction that Lyft will hit pre-pandemic records for riders in that span of time?
I'm not going to provide any new guidance. So what we have said is that we're cautiously optimistic that we will exceed our growth rate from last year on top line, and we remain cautiously optimistic, which would be a very good thing.
Now, I have to ask you this story about a potential kidnapping attempt by a Lyft driver in Brooklyn. It's getting a lot of attention. The rider says she tried to file a police report. She couldn't because Lyft didn't carry the license plate. She said she didn't get a call from Lyft or an apology. What's the status of this case, and what are you doing to investigate and make sure this doesn't happen and that this person, this suspect, potentially is brought to justice?
I'm not familiar with the specific case. I can tell you that license plate is something that we track, and my guess is that there has been a call placed to that individual, both the driver and rider, to determine what has happened. And I would just emphasize all of the things that we've done on safety over the past several years. A feature called silent escalation, where a driver or rider in an unsafe situation can tap a button silently. And we've partnered with ADT to provide any emergency services that would be necessary. We also look at any anomalies in route. If someone stops for a long period where they shouldn't, we ask both rider and driver if they're okay, and if they need any of those ADT provided services. So again, I can't comment on that specific incident in question, but I can say safety is incredibly important to us and something that we continue adding more products to.
All right. You also released your first sexual assault incident report back in October. Is that something you plan to do regularly? When will we see the next one?
We haven't made that decision yet. Our focus is on making sure we provide safe rides. And if that helps do that, then that's something that we can consider. We've continued to improve, again, those safety features. And when you compare it to alternative modes of transportation, like the modes like taxis that came before us, having identity, having license plate, having all this information is leading to safer outcomes. That's one of the reasons we started this business. And that's one of the things that we get up every day working hard to improve.
All right. Good to know. John Zimmer, Lyft president, co-founder, thank you so much for joining us, as always, to break it all down. Coming up, Microsoft is revealing a new app, new rules in an effort to ease approval of their deal for Activision. We'll discuss that and more next. This is Bloomberg. Microsoft began to make its case in Washington to ensure the purchase of game giant Activision gets approved. For more, I want to bring in Bloomberg's David McLaughlin, who met with Microsoft CEO Satya Nadella and President Brad Smith today in Washington. How did that meeting go, David?
Microsoft is, I think, on a bit of a charm offensive after this deal. They're trying to deliver this message in Washington that the future they see is one where, app stores are open, don't come with a lot of the restrictions that have come under so much criticism. And really what this is, I think, is an attempt to tell regulators that are going to look at the Activision deal that they don't have anything to worry about in terms of
Well, do they?
whether it will hurt competition. Well, yeah, I think obviously this deal is a huge deal, and it's happening at a time when there's so much scrutiny of big tech companies and a lot of criticism that in the past enforcers sort of got it wrong when it came to tech companies buying other companies. So they let kind of these companies sort of gobble up rivals, and so that's the environment. And enforcers that the Biden administration has appointed to the FTC and the DOJ are, so far talking a much tougher game. And I think one of the real serious concerns about this deal is that Microsoft would essentially be able to withhold Activision games from other console makers, and
Right.
And so that's something that is going to get a pretty hard look.
So what's your bet? Does the deal get done or not?
I would never want to predict what enforcers would do. I would say that this issue of whether Microsoft might want to or have an incentive to withhold Activision games and keep them exclusive to Microsoft, that's something that that's a concern that's common in these types of deals, which are called vertical deals. They're not direct competitors. And worth pointing out that the FTC, the last two merger challenges they brought were both vertical deals. And the votes to bring those cases were both unanimous.
Okay, well, thanks for sharing some color from that meeting. We'll continue to watch, obviously, how that deal progresses. Bloomberg's David McLaughlin, thanks so much for joining us. Coming up, we will revisit a term we use a lot on this show, unicorns. We're going to talk about what it means to be a unicorn today in the ever-expanding club of unicorns. Cowboy Ventures founder Aileen Lee, who came up with that term 9 years ago, will join us. This is Bloomberg. Welcome back to Bloomberg Technology. I'm Emily Chang in San Francisco. Big tech making a big comeback. Let's get an update with our Kriti Gupta. Kriti, what do we see?
Yeah, Emily, one of the big questions I think in the market is the bottom in? Is that selling that we saw at the start of the year? Is it over? Well, maybe. Take a look at this chart. You are actually seeing, this is the S&P 500 information technology sector. After a 15% drop, it's actually pared back some of those losses. It's halfway back in that. One of the big drivers of that is, of course, going to be your big tech names. And I really want to take a look at what that performance looks like, not just in the last 3 weeks, but in the last 6 months, because there is a clear outperformer even in the big tech space, and it is Apple. It is Microsoft, those hardware companies outperforming the social media companies, the ones that are essentially more exposed to the economic cycle, to that business spending. Alphabet in the green, but only about 2.5% over 6 months. And of course, Meta Platforms, the real laggard here, losing 36% of its value in the last 6 months, at least according to its stock price. But let's talk about what else is impacted by these big tech moves. It's not just these companies, it's semiconductors as well. And I love to look at this gauge because semis to me kind of show a magnified approach of what you're seeing in big tech. So if semis rebound, big tech kind of follows its lead. So big tech, semis, actually, the SOX index had bottomed out before the broader index did. And for me, that was a big kind of gauge of whether or not the bottom end is in. And for now, looking at those technical levels, bouncing off of its 14-day RSI, it does actually look like semis have pared back some of those losses too. So Emily, things are looking good for now. Let's hope they stay that way for the bulls.
All right, Kriti, thanks for the update. Meantime, software toolmaker Product Board is the latest company to hit prized unicorn status, becoming number 1,000. But what does it mean today to be one in a field of 1,000 unicorns? That phrase emerged nearly a decade ago when startups worth $1 billion were rare and treasured. But with startups and investors looking to give the next successful company its horn, we may need to revisit what is and isn't a true unicorn. Joining us now, the investor who coined that term, Aileen Lee, founder and managing partner of Cowboy Ventures. Aileen, great to have you back with us. So curious how that number 1,000 unicorns now strikes you when there were only 39 unicorns back in 2013 and when you coined that term.
I know. Well, thanks for having me, Emily. I'm super happy to be here. Now, I guess I will point out that when we did the analysis in 2013, it was just a US-based list. So the 1,000 list is about half US, half international. So it's really maybe like 500 to 39, but still it is quite an amazing growth in the number of unicorns.
Should a unicorn still be a $1 billion company, or do we need to raise the bar? Should it be a $2 billion company?
I know this question comes up a lot. Look, it's still super rare and very hard to achieve. So yeah, I think what's exciting is that kind of the ceiling has been lifted. So, I mean, when the first analysis was done, there was only one company worth over $100 billion. Now there's a bunch of them, right? So I think the markets for tech companies have gotten bigger, they're global. Sadly, you know, the pandemic has inflicted so much pain on all of us, but it's also kind of like cemented this opening for software and technology to become a bigger part of the scaffolding of our life. So I think tech will continue to grow as a sector, and you know, the composition of the list has changed, and I think that's really good for tech, but it's still really hard. I mean, the probability is still extremely rare if you start a company that raises venture capital for you to achieve a valuation of over $1 billion. And it's also harder than ever to keep it there and to keep it. I mean, just look at all the turmoil going on in the market right now. Like the sustainability of like staying in that zone for a long time is hard.
Does that mean you don't think that private markets are overheated? Because I hear over and over again that valuations are just too high, and there's so much money out there flowing in.
It's both, right? Like I think yes, I mean, I remember a time when companies traded at 5 times revenue, right? In SaaS, it's like hasn't happened in a long time. So the multiples are pretty big relative to where they have lived, but a lot of the companies have grown into the valuations because the markets are so big. I mean, I know Meta has been having a really rocky start to the year, but just look at the revenue that company drives. Like, you know, I remember when people laughed at Facebook raising at $100 million valuation because people were like, how will they ever make money? It's free. No one will buy ads on Facebook. I mean, the amount of revenue they drive is incredible.
So we're looking at some of these private companies that are, you know, Stripe, $95 billion, SpaceX, $100 billion, still haven't gone public. Do you condone the use of the word decacorn? Is that good for the next phase?
You know, it's funny, like in that piece that we wrote, we used like mega unicorn, I think, and decacorn. I was reading, I think,
Centacorn?
Yeah, Crunchbase was using like tricorn and quadracorn, things like that. Like whatever people want to use is cool with me. I didn't expect anyone to use it in the first place. So it's kind of, I know it's annoying to some, but it's useful, I guess.
A whole breed of corns have been born. I got to ask you, you're also the founder of AllRaise. You're one of the biggest champions for getting more women into VC, more women entrepreneurs funded. We just got a really, you know, honestly kind of a depressing statistic that women founders got just 2% of VC funding last year. Why is that, given all of the momentum, the talk, the work that you and AllRaise have done to change this?
Yeah, we've got a lot of work to do. You know, when we founded AllRaise, we said, look, this is a marathon and we cannot let up because we have, you know, centuries of bias to undo in not just tech and not just finance, but pretty much in every sector of the economy, in healthcare, in law, in government, in advertising. There's just a ton of disproportionate power held in the hands of institutions that have a lot of embedded bias. So I think we are making progress on the funding side in terms of changing the composition of the VC industry. We have grown it, and I'm hoping that that's a leading indicator and that founders will follow. But yeah, we are not making as much progress. Oh, there's my dog in the background, sorry.
All right, meantime.
We're not making as much progress as we need to for female founders. And so I think it's up to everyone in whatever job they have to examine the ways that they can make a positive difference with who they hire, how they have one-on-ones, how they promote, who they give projects to. There's ways that everyone can have an impact on making it more fair.
So let's talk about having an impact. What trends are you doubling down on in Seed these days? Are you excited, for example, about the metaverse, or is that overhyped?
I think the metaverse is just like, what does that mean, really? If you mean the metaverse, like, are we all going to be wearing VR headsets and staying in our houses all the time? I think that's, if we're lucky enough to emerge from our caves after this pandemic, I think at least for the next 3 to 5 years, people are going to be more excited to engage in real life than ever before. Like restaurants, hospitality, travel, fashion. I think people miss real life experience. I think actually the experience economy and the access economy is going to boom. Now, where people are going to live, both like the unicorns of the future, what countries they're in, what cities they're in, that's going to change. So I do think that the software that actually scaffolds our ability to communicate with each other and the ability to collaborate and work wherever we are, that is going to continue to grow like crazy. And also vertical software, whether it's in healthcare and ed tech, where I think those are categories that if you look at the original unicorn analysis, fintech was a tiny component of the list of US-based unicorns, and now it's a huge component. So I think we're rebuilding the infrastructure and kind of the rails of all the major categories of our industry. And I think Larry from BlackRock made a comment about how he thinks a big component of the next set of unicorns is going to be energy tech. I hope that's true too.
All right, we'll be watching Aileen Lee. We're going to let you get back with your dog who's been hanging out back there. Cowboy Ventures founder and managing partner. Thanks for the cameo. Appreciate you taking the time. Coming up, DoorDash enters financing. We're going to have more on the meal delivery company's new effort to help restaurants grow. That's next. Plus, a conversation with Disney CEO Bob Chapek coming up you don't want to miss. This is Bloomberg. A few stories we continue to watch. A New York judge has granted bail for 2 people charged with trying to launder billions of dollars worth of Bitcoin. The cryptocurrency was stolen in a 2016 hack of the Bitfinex currency exchange. Ilya Lichtenstein and Heather Morgan were arrested yesterday. The government seized about $3.6 billion of cryptocurrency from the couple. Plus, the biggest meal delivery service in the U.S., DoorDash, is starting a financing arm to offer loans to restaurants on its app. DoorDash Capital will allow restaurant owners to apply for financing to pay for equipment, rent, hiring, and payroll. The money can be dispersed in as little as 1 or 2 business days. And Tesla expects to be sued by California over allegations of racial discrimination and harassment. The electric car maker says the suit has to do with claims from workers at its factory in Fremont, California. A legal battle could inflame tensions between the state and Tesla CEO Elon Musk. Last year, the company moved its headquarters from California to Texas. Coming up, deep dive on Disney. Disney CEO Bob Chapek will be right here. This is Bloomberg. Welcome to our global television and radio audiences. I'm here with Disney CEO Bob Chapek on the heels of the company's first quarter earnings. We're going to talk about everything from the streaming wars to theme parks, the ongoing pandemic, and even the metaverse. Bob, thank you so much for joining us. I want to start with this month marking 2 years with you as CEO. Bob Iger has officially ridden away from the happiest place on earth, and I want to know how you're feeling. Do you feel like your strategy is clicking and that things are working?
Well, I think as evidenced by our most recent quarter, everything's falling into place. You know, we're filled with optimism here at Disney. We're at the point where we're just at the start of the last year of our first 100 and the inflection point for the start of the next 100. And I think if you look at our parks business, you look at our media business, all fueled by the great content that our internal storytellers get to tell, we're full of optimism. We think that we've got a lot of energy and momentum. We've got a vision for the future, a vision where we're going to appeal directly to our audience using technology and great storytelling. And we really think that it's going to be a more exciting next 100 years than even our stellar first 100 years.
Give us some color on what's driving the burst in subscriber growth at Disney Plus compared to the slowdown last quarter.
Well, you know, we had said for a long time that it's not going to be a linear growth quarter to quarter on Disney Plus, that there were going to be some quarters a little higher, some quarters a little lower. And it's really almost directly a function of what the new content is that's flowing into the service. And obviously that content was impeded and made a little choppy even more by the fact that, you know, we had COVID and it interrupted our production cycles. But as we stated last earnings and this earnings as well, is that that flow becomes a little more steady, a little bit more predictable, a little bit more optimal during the second half of this year. And we expect that we're going to actually add more subs in the second half of the year than the first half of the year. So we're very encouraged by that. Again, it'll still be choppier than a perfect linear line, but you know, when you have great storytelling and great brands like we do, it's going to draw a lot of people across the globe. So we're excited about that.
Now, you said it was hard to get people to the theater for family movies, and I wonder when you see that changing and what that means for the next few family titles.
Well, we're very carefully watching the return to theaters, and obviously when you have something like Spider-Man that comes out into the marketplace and it does, you know, gangbusters numbers, we're very encouraged about that, you know, so let's call it the 18 to 34 target demo. That seems to, if you've got the right movie, big blockbuster, great film, based on a franchise, that's back. We are a little more concerned, though, about the family films and some of the films that appeal to the over 35 audience. But we're very, very lucky in that we have the ability to take our films to all the audiences on Disney Plus. And we're encouraged. We hope that the family audience comes back to theaters. But we believe that even with a title like Encanto, which, as you know, has proved to the world that we can build a Disney franchise on the back of Disney Plus, because our licensed merchandise spiked as soon as it came out on Disney Plus. The music went from, I think it was 197 on the top 200 in Billboard to #1 for multiple weeks in a row. We can build a franchise on Disney Plus, so we'd love for theatrical to come back for family movies. We hope it does, but if it doesn't, we know that we're very secure in being able to use our own platform, Disney Plus, to help do that.
We're here with our Bloomberg television and radio audiences with Disney CEO Bob Chapek. I want to talk about parks in more detail. You hit some all-time records with revenue there, but attendance is still, you know, lower or in line, depending on the park that you're talking about. What's the outlook ahead as Omicron wanes? Are you preparing for new variants? Do you see hitting new records in attendance, or is it all about revenue?
Well, we're preparing for anything. I think if the last two years have taught us anything, it's to remain flexible. But if we have a focus on our guests, we believe that it's going to turn out just fine. I think one of the reasons why we've had such a recovery in demand and attendance at our parks is a function of the fact that consumers, our guests, our fans trust us. Not only do we deliver great experiences and tell great stories, but they trust us. And we're going to move very slowly when it comes to attendance increases, because we feel that we want to be very, very responsible. And some of the reasons why we don't have max capacity right now is that we still haven't turned on all of the live entertainment that we've got at the parks, which, as you know, is a really big component of a great Disney experience. But we're moving slow on that because we want to make sure that as you densify people, that our guests feel very comfortable. And we do surveys all the time in terms of what our guests feel is the appropriate density. And so we're metering that. But I must say that the operating performance of parks using that approach has been extraordinarily great. As you know, in our domestic parks, we had a record quarter this past quarter. We're very, very excited about that because even without being able to, maximize the density inside the park because of everything I mentioned, we're getting great performance. And so that, I think that says it all. So no matter what set of circumstances or situations, the world throws at us at Disney, because of our 195,000 unbelievable cast members, they find a way to make our guests have magical memories that last a lifetime.
Now, Disney is leaning into the metaverse, and I'm wondering if you can give us more details on your vision. How could Disney offer products that fit into this? Is it about Lucasfilm? Is it about Industrial Light and Magic, for example? Paint the picture.
It's about all those things. If you step back from it, regardless of where you want to call it, we believe that there's a world where we can add a third dimension of storytelling. I call it sort of a three-dimensional canvas, so that we can take the folks that make our great television shows and make the great music and make the great movies and the great theme park attractions. And what happens if you enable them, you give them the degrees of freedom to paint on that third dimension and don't necessarily constrain it with typical definitions about what's a book, what's a recording, what's a movie, and you let them kind of explore and use both the physical worlds that Disney is uniquely postured to create in our theme parks, but also take the media and the digital and the virtual pieces, which we also have shown that we can do, and use Disney Plus as an opportunity to bring those two things together so we can tell stories in that third dimension. I think it's a great opportunity for us. I think it's the next great horizon for Disney. I think it's the next great horizon in entertainment. And I don't think anybody's as situated as well as the Walt Disney Company is to have our creative geniuses work on that to tell the kind of stories that guests will expect in this new modern world.
You've said you're investing heavily in international local content. Give us some specifics. What does that mean for markets like China and India, especially in light of Netflix's recent hit Squid Game? What's going to drive growth in some of these other markets?
Well, in many of the markets, obviously, we've got global titles that have worldwide appeal, whether it's, Lucas or Star Wars or Marvel or Disney. But in addition to that, we found out in our brief 2-year journey on direct-to-consumer that the localized content in some of these territories is extraordinarily important. And we announced that we were doubling our content slate internationally, and as a result, we're finding that now can be a very major driver. It's not just our great global franchises. Those certainly are a big piece of it. In some markets, it's sports, but really those localized productions, and we just had an organizational change here at Disney that's really going to accommodate so that we can shepherd some of those developments and keep a closer eye on them. But that is really going to be a major driver for us in those local territories. And we're hoping that we've got the ability to have some of those actually flow backwards and become big global franchises as well. So we're all in on local productions, and we've got the experts to do it inside each market.
Okay, I got 30 seconds, Bob. Any update on a sports betting partner for ESPN?
Well, as you know, we believe that aspect of the business is increasingly important for the younger audience who wants to lean forward and engage in sports, not just sit back passively, and we want to enable that. We're bullish about the future of sports at Disney, and whether it's the metaverse or whether it's sports betting, we're all in.
Bob Chapek, CEO of Disney, from the lot. Thanks so much for joining us. I'm going to toss now back to all of our global outlets. And that does it for this edition of Bloomberg Technology. Tune in tomorrow. We've got more earnings coverage. This time, we'll chat with Ned Siegel, Twitter CFO, and Patrick Spence, CEO of Sonos, and so much more. We'll see you then. This is Bloomberg.